In this video, I'm going to go over what a mitigation block is and what a favela gap is and how you can combine those two PD arrays. So the first thing I'm going to go over is what a mitigation block is. So let's say price comes down to a form of resistance level or sell-side liquidity, and then we start to move higher, and then we go lower, making a failure swing low because price fails to take out these lows, and then we move higher, creating a shift in market structure because we close above these highs, and then we move down into the shift in market structure or a mitigation block. So the reason this is a mitigation block is because price come down and make the failure swing low. So is the up movement before the failure swing low, and then after we make a shift in market structure, then we create a mitigation block. So we have the failure swing low, and then create a higher high or a market structure shift. After we create the market structure shift, we want to use the highest up close candle before we make the failure swing as our mitigation block. So now that we have our mitigation block, we want to see price come down into the mitigation block and then move higher. And after we move higher, you could also see we create a new mitigation block, because you can see we create failure swings right here, the failure swings that come down and touch the mitigation block. Then you see we make another shift in market structure right here. And then we come down again and touch the mitigation block and move higher. We don't need to make a second mitigation block, but it really just depends on where your target would be. So let's say we have buy side liquidity up here, then we wouldn't use this mitigation block because we want to see lower prices. But if we had buy side liquidity all the way up here, then we could use this mitigation block and then target the buy side liquidity. So it's really just about looking if there's any buy side liquidity near your mitigation block. So just to give you a better view of this, we come down and touch the resistance level or sell side liquidity. Then we move higher, and then we move lower, creating a failure swing low because we fail to take out these lows right here. Then we move higher, going over these highs and making a market structure shift. And right when we make the market structure shift, we want to be looking at this range right here because that is where our mitigation block has formed. Then we want to see price moving lower into this mitigation block and then moving higher, making a new mitigation block because we made a shift in market structure right here. Then we go lower into this mitigation block, and then we go all the way up to this buy side liquidity. So now we couldn't be anticipating a mitigation block right here because we touched the buy side liquidity, so we could expect a reversal in price. And as I said before, it's very important looking for the buy side liquidity because that is where price is going to reverse. And if you think this is a mitigation block, then you probably are going to get stopped out because price is going to make a smart money reversal and probably going lower, taking out all these lows right here. So for the next example, I'm going to show you how you can combine a mitigation block with a favela gap. But right before I do that, if you look at it, this looks like a market maker buy model. As you see, we probably have right at these failure swing low, a low risk buy. Then we have first stage accumulation and second stage accumulation. But I have made a video about that. So you can go check that out if you want to learn about this. So when I'm looking for a favela gap with a mitigation block, I mostly want to see the favela gap combining with the mitigation block, as you see right here, because then there's two PD arrays that will support price in going higher. So I assume most of you guys know what a favela gap is, but if you don't know it, I'm just going to give you a short explanation of what it is. So a favela gap is whenever there aren't any wicks or bodies overlapping a body, creating a favela gap. So what I'm basically trying to say is when we have this wick low all the way up to this top of this body, we have a gap when there's nothing overlapping this body. So as you see right here, this isn't a favela gap because the wicks are overlapping the body, as you see right here. But this favela gap, there aren't any kind of wicks or bodies overlapping this body right here. So it creates a favela gap. And as you see, price come up and respect this favela gap and then go lower. So now that we know what a favela gap is, we want to see a favela gap within a mitigation block. So let's say from this fail swing low all the way up to this high, we want to see a favela gap forming that combines with the mitigation block as you see right here, and then we want to see higher prices. So now that we know what a mitigation block is and how you can combine it with a favela gap, we can go into the charts and find some examples of this. For the first chart example, we have already taken out this sell side liquidity or resistance level. So now I want to see price moving higher. So right here we make a failure swing low. So now I want to see price moving above this high to make a shift in market structure. And right here we close above this high. And as you see, we want to use the last up close candle before the failure swing lows. And as you see, within this mitigation block, we have a favela gap that gets respected, as you see right here. So right here we have a mitigation block plus a favela gap. So if you were to take a trade entry, you would enter right here at the top of the favela gap and put your stop loss at the failure swing lows, because these lows we shouldn't touch before we go up to any form of buy side liquidity. So now we can zoom out and target these highs right here, making a free risk reward ratio. So now let's see what happens. Right here we come down and touch the favela gap again. So now I want to see price moving all the way up to the buy side liquidity. And right here we go all the way to buy side liquidity and close above it. We also made another mitigation block, as you see right here, because we make failure swing lows right here, and then we close above this high, creating a mitigation block. But personally, this wouldn't be a high probability trade entry, because if you were to take a trade right when we touch the top of the mitigation block, you wouldn't be making a good risk reward ratio if you put your stop at the bottom of these failure swing lows, as you see right here. Just to give you a bit of view of this, we come down and take out this sell side liquidity or resistance level. Then we start moving higher, and then we make failure swing lows, and then we create a mitigation block, as you see right here, with a favela gap right here that we respect and go all the way up to this buy side liquidity. And then after that, we make a new mitigation block right here because of these failure swing lows. And then we come down and respect it and go all the way up to the buy side liquidity. So for the next example, we have created a SMT, as you see right here. That means on the S&P 500, we took out these highs, but on the Nasdaq, we failed to take out these highs. So that means we could expect a reversal. So now that we could expect a reversal, we want to be looking for a mitigation block. So let's see what happens. So right here, we start to move upwards, and as you see, we touch this favela gap. So now I want to see price move lower, closing below these lows, creating a shift in market structure. And right here we close below these lows. So that means this is our mitigation block, because these are failure swing highs because we didn't make a shift in market structure closing above these highs. So now that we have our mitigation block, we want to find a favela gap. And right here we have a large favela gap that we could use with our mitigation block. So let's see what happens. Right here we touch our mitigation block. So if you were to take a trade entry, you would short right at the bottom of the mitigation block and put your stop loss at these highs and target this sell side liquidity all the way down here. Or you could also use standard deviations from this high to this low. And you see the -2 to -2.5 range aligns with this low right here. So let's see what happens. And right here we come all the way down, touching the -2 to -2.5 range, and this sell side liquidity down here. So just to give you a better view of this, we come up and make a SMT right here because we failed to take out these highs. And then we start moving lower, and then we make a failure swing high up to this favela gap right here. And then we move lower, closing below this low, making a shift in market structure. And within this shift in market structure, we create a mitigation block because these highs right here are failure swing highs. And within this mitigation block, we create a favela gap. And if you were to take a trade entry, you would take a short right at the bottom of the mitigation block and put your stop loss above the failure swing highs. And then you could use standard deviations from this high to this low at this failure swing highs and target the -2 to -2.5 range. Or you could target this sell side liquidity down here. And we also created a new mitigation block right here, as you see, because we created failure swing highs up here to the first mitigation block, and then we close below this. So now we could expect price going up to this and maybe moving lower. And that we do right here. But this second mitigation block wouldn't be the best trade entry because we already took out the sell side liquidity, so it could be a lot of risk taking a trade right here. If you like this video, please like and subscribe, and if there's anything you didn't understand, just comment down below.